You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo, back from a bit of a hiatus, traveling a little bit hither and yon. Some planned travel, some unplanned travel, but now I'm back in the big hosting chair. And of course, you can always find us at theoptionsinsider.com, as well as, of course, the ever exciting destination known as the Options Insider Radio Network. You can find that content anywhere you find your favorite podcast programs, pretty much hither and yon, iTunes, TuneIn, Stitcher, so on and so forth. I know a lot of you are adding the Google Play podcast to your list now because you can get it there. So check it out there. If you have problems there, don't blame us, blame Google. So reach out to them. They're still rolling it out. And some, you know how they like to do betas for years. I think Gmail is technically still in beta. So play with caution there. Of course, you can always just grab our app on the Android side, and as well as the iOS and the even, I believe, Amazon Fire side. It is funny to see so many iOS users using our app because, quite frankly, the podcast app in iOS sucks. It's terrible. It's broken, and it has been broken for years. So it's amazing that podcasts have survived despite the tender, loving ministrations of Apple. But that's a conversation for another day. And joining me on the old program today, we are joined by the Rock Lobster himself, Mr. Andrew Giovinazzi from the Duchy of Maine, by way of a little place we like to call around here, the Option Pit. Mr. Rock Lobster, welcome back to the program, sir.
It is lovely to be here. Lovely to be on Vol Views. I'm missing Russell. Are we going to get a drive-by or a drop-in, a something? Something or other?
I honestly do not know. You are referring to, of course, the infamous Dr. VIX, or at least he's aspiring to become Dr. VIX once he does get perhaps that doctoral.
Are we going to have to call him that? Are we going to have to call him Dr. VIX?
Probably.
Oh, it's Dr. VIX again.
He wants that. He's going to put it on his business card. I just call him.
Totally.
I call him Mr. Corner Office for now because it's kind of silly and fun, and because his office is nothing like that if you've ever seen it. But it makes it kind of fun. We are dialing him via multiple outlets, via multiple points of outreach. I'm not sure where he is today. If he's local, if he's off in the hinterlands of Oklahoma, studying to become Dr. VIX, or if he's doing something else. I thought he might even be swinging by here today, but in the studio, but he is, alas, not here. So I'm thinking, Mr. Rock Lobster, it's going to be a little bit of you and I here for some extended breakdowns of all things volatility. Are you ready? Are you prepared for such an in-depth adventure, sir?
I'm going to give it my best, Mark. I am. I'm going to give it my best.
Your overwhelming enthusiasm, sir, is infectious. With that infectious enthusiasm, let's roll. Let's go. Let's keep on going right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. Welcome to the Volatility Review. This is indeed the portion of the program where we're breaking down, actually, let me just get rid of that. There we go. The behind-the-scenes machinations of the show. You guys hear it when you're going live. So if you're in the chat room, you hear how the sausage is made. But, of course, welcome to the Volatility Review. This is indeed the portion of the show where we break down what's moving, what's been shaking, what's been rocking, what's been rolling in the week that was, and indeed still is, from a volatility trading and analysis and research and developments and trends perspective. We are recording this and indeed live streaming this on Friday, right about noon Central Time, heading into the long holiday weekend. I think a lot of people are already starting to filter out and get the heck out of Dodge. We are seeing a bit of a rally here in the broad market. Most of the major indices, S&P, Dow, and the NASDAQ, up about 0.3% or somewhere in that ballpark as we are streaming live here today and recording. VIX cash roughly even on the day, right around the 13.5 level, a little bit south of that. So we're seeing some interesting stuff out here. I don't know, before we even get to what's been going on in the VIX realm and everything else, Mr. Rock Lobster, I don't know about you, but I seem like, I'm not sure why it is, but it seems like VIX movement over the past week has prompted a lot of inquiries into like what's going on. It seems like we're getting more than our usual share of questions about why is the VIX doing this, or why is the VIX here, or why is the VIX at this level? Is it low? Is it high? I don't know. You guys, are you seeing that as well, like in your chat room and from some of your mentees? Is there seem to be an increased interest right now in what's up with VIX cash, or is that just our little microcosm of the universe over here?
Well, I think it's two things. One, it's probably because all we do, we do a volatility analysis every day in our chat room, just because we're always trying to, guesstimate where volatility can go and what trades look the best given where VIX is. So I would say it's not any different from us, but I think what's going on is people are wondering why VIX keeps going down. I think that, why is vol so low? Why is vol so low? Well, because I think there was a bit of a surprise last week with interest rates with Yellen, and everybody thought, oh, we're going to raise rates and things will be awful. And then it was for a couple of days, things were bad. And then they weren't. And then they tanked the VIX. So I think for me, there's always levels of VIX. I have it broken down into zones, and we're at the point where we can't quite get into the lowest quartile for VIX. It just keeps hanging right here. But what is I think interesting is all the premium in VIX is in the volatility future still. That's where it is, and it's actually not in the cash VIX itself. And the forward volatility in the terms for the S&P 500, the weeklies, is super low. It's all in the single digits now. So the turnaround in volatility has been, let's just call it quick. We were just trading at a 16 VIX last week, right? And it is gone, totally gone. And I think part of that was Greece. There was some restructuring of Puerto Rico, I think. Just a lot of those sort of kind of scary macro issues went away. And here we are sitting at a 13.5, which was where volatility was for most of our lives in the 90s or lower. So just depending on what decade or the couple of decades that you've traded. So there's nothing too unusual about VIX being at this level, but you've got, the S&P 500 is close to 2,100. That usually VIX should be kind of in the lower area. So last year at this time, though, VIX was probably, with SPX here, was at least a full handle lower. So there's still some Brexit issues and some other. I think there's a bigger GDP number, because now every month now a number matters, because of the confusion and delay caused by the Fed. So that's where it stands. So is it an unusual place? No. Is it feel like it's kind of in the right place for how things have been trading? Yes, but the vol futures are crazy expensive. Relative.
It's interesting you mentioned about the zones. That's something we haven't really talked about before. I'm kind of curious about that before we even get into the other analysis of what's cooking out there right now. How do these rock lobster zones work? You say you can't get to the bottom zones. So that means in terms of your zone ranking for VIX, are we in zone 3? Is that how that works, or is that zone 9 out of 10? How do these zones of yours work?
What I do is I've broken basically just into quartiles to teach people about volatility, easily. We try to make it easy at Option Pit. So zone 1 is from 10 to 13, essentially. Zone 2 is 14 to 17. The zone 3 is 18 to 22, and 18 to 23, let's say. And zone 4 is 24 vol and higher, basically. So, because the thing is kind of the market acts in different ways in those different quartiles. Zone 1 is very hard to get into, and it's very hard to get out of, meaning once vol gets low, it's usually there for a reason, and we're not going anywhere. It doesn't move very much. Certain types of trades don't work very well. Other ones work great. And you got the opposite, where you have zone 4, when the realized volatility, just every day it's, woohoo! You have no clue what's happening, because when VIX is trading 24, by definition, the market's moving, at least 1.5% per day in some direction. So you remember for a while when when listeners were coming in or listening in January, February, a 30 handle move in the SPX was every day. Before the opening, 30 handles, 40 handles, whatever. Boop, boop.
Out of the good old days.
Yes, and that's why. And so what I'm trying to tell people is, and then we teach them, about there's certain types of trades that work in each zone. You have a better chance of putting trades on and succeeding when volatility is in a certain quartile. Just equities are a little different, because equities could have way off the curve moves quicker than the index can, but it's basically the same idea. So with VIX now, we've been kind of pressing on this zone 1. We get to it, and then we kind of bounce again. We get to it, we bounce again. It's been happened like 3 or 4 times this year. We just can't break below 13 and stay there. And that's what we have right now, where we're trying to press to that ultra low volatility realm, which is the first, basically the first quartile of VIX. And I say 10 as the low because theoretically VIX can get below 10. It has not, I would say, in a very long time. So basically when I look at this, I go, okay, well, it's 13 and lower, and we just can't get there. We can't get down to 12, can't get to 11, can't get to 10. So that's the lower side, and the lower side are different trades. Generally, the market's a lot more stable. Like you could be a little more bullish, maybe. Things like that work better. You always are prepared for a zip, and also what I say is there's always the potential where you could have some overnight news that is crazy, and you move from one zone to another. So from lower vol to higher vol, or the opposite. So it basically helps people break down, the types of positions that work really well, because the market is doing a certain thing. What I do is you kind of, you put on trades for the movement that is being priced now, and then you manage risk for the stuff that you don't, that could happen at any time. So that's sort of how we help people sort of, decide how to put trades on and how to manage risk in their portfolio. And, it's kind of how we manage risk in our funds, sort of same idea. So that's basically kind of the underpinning. So what's the market doing? Because you have to take the price signal the market gives you, meaning when you're in the lower zone, what are the possible trades? So if you buy VIX in zone 2 going into zone 1, you're like, woohoo, we're at the low end, vol's going higher. And I go, well, but the vol futures trade a certain way that way. So you're probably paying relative the most you can pay for VIX right now if you went and bought some calls in there, because the vol futures in June and July are relatively expensive to where the cash is trading. So you have to figure out a way to make that cheaper. And then, of course, that's all the stuff we do around volatility and option pit. You're like, how do you find the cheapest way to buy upside in VIX? And, of course, there's all kinds of ways to do that. And right now, we're looking at it, can we actually sink into zone 1? And my thought is, well, you have a Brexit vote coming up. You have kind of more of these Fed things coming up. All that stuff is uncertainty. And anytime there's uncertainty on the calendar that you can kind of mark, VIX doesn't tend to get into zone 1. So I would bet every time we kind of get down to that level, we're going to bounce back out. Now, how you play the bounce is through all kinds of stuff. You could buy puts in the S&P 500, or depending on what looks like the tastiest or most interesting type of trade at the time. But right now, like buying the vol products, you could be catching a falling knife in the vol products over the last week. They have had pretty dramatic drops. We actually had our positions in our strategy letter were more short them with little tiny upside hedges, but they got relatively expensive. The VIX futures got really expensive relative where things trading. So as you kind of start to drop down in volatility, the way the products work and the way the futures work, there is a huge potential for decay. And even if you have a pretty decent vol move back the other way, it's almost not enough to make your money back for any vol product you buy. So there's lots of stuff going on in the vol products, but they work in certain ways. And then once you understand how they work, they're 1,000 times easier to trade. If you don't understand how they work and you try to trade them, all I do is good luck.
That could be a subtitle for the show. Lots of stuff going on in vol products. And
yes, there is. No question. So hopefully that wasn't wildly confusing to people. But like I said, when you're in a 13 vol market, there's certain things to expect, because that's just what volatility, and as Don would say, also how the realized volatility is relating to how the markets and pricing implied volatility. So that's basically the second part of our analysis is, okay, the VIX is here, but the market's doing this, right? What's expensive, what's cheap, what looks good, what kind of trades will pay us. So, and I think that's kind of where we find ourselves. We're sort of on that sliding area where, frankly, there's not a lot of, I don't think there's tons of downside in the VIX cash, but there's a lot of downside in the futures, in the VIX futures. So it's one of those things, okay, so how do you create that? How do you create that position? So that's actually, we closed some of those this week, and we actually started pricing them for next week. But no sense doing them today. Might as well wait till, Tuesday. And that's where we are. That's our volatility review of the week, at least from the option pit view.
At least the option pit zone breakdown. That was an interesting zone by zone, quartile by quartile breakdown of all things volatility. If you like more of that, by all means, check them out over there in the land of the pit. We'll get them their plug early, optionpit.com. I know a lot of you are probably heading out for the long weekend early. I know today is probably one of the busiest travel days of the year. Everyone getting out there ahead of time for lining up to meet family and hit some barbecues. But we're still talking vol here. We're not going anywhere, at least not for the foreseeable future. We're here to talk some vol, and later today, of course, some futures options. But Andrew, going back to VIX cash for a second, has been kind of an interesting week, like you were talking about. It had that kind of interesting evolution over the course of the week, starting off high right around the 16.5 land earlier in the week. We saw this continued evolution, movement to the downside, but you're right, had some struggles really breaking through that 13 level. We saw some numbers today, and you're right, it seems like doesn't like every number suddenly in the wake of the Fed paying attention. All of a sudden, every number has some significance. We did see a GDP revision today. The GDP for the first quarter was revised. It came in at 0.5% in the first quarter, but of course, that was without the revision. The economists are actually expecting it to revise up to 0.9%. Got revised all the way up to 0.8%, which is less than expected, but still a pretty formidable increase. And again, with everyone kind of fixated on the Fed and what they're going to do in a couple of weeks, any sort of bullish sentiment for the economy, however meager or anemic it may be, is yet another arrow in their quiver for whatever raise they may inevitably do in a couple of weeks over there. So all of a sudden, you're right, Andrew, this number that normally we look at GDP revision, we'd be like, whatever. But now in the glare, in the headlights of the impending Fed action, all of a sudden, this GDP revision has some legs to it. Of course, not enough to derail the market. Like I said, we're still in rally mode, if it is somewhat slight today, but still. Did that surprise you, Mr. Rock Lobster, that all of a sudden everyone's talking GDP revisions when usually this is the number we kind of just wash under the table there?
Yeah, I think it's enough to make kind of the bullish case where we're almost, you remember like all good news was bad news and bad news was good news in the QE period. And I think and I don't know if this is a conscious effort by the Fed, but it could be, to kind of just punch drunk the market into not caring about the whatever they say about interest rates anymore, because everything becomes, all the stuff they say is, we're raising, we're not raising, we're doing this, we're doing that. It's all so nonsensical that people just find it's like their 80th punch to the face that just doesn't matter anymore. And now all of a sudden, okay, so good news is good news. Their rates are raising, and because things look better. And actually, better news is better now as we it's just this getting over the hump of getting out of the QE era. You notice you haven't heard too much more, like all the QE pronouncements from Europe and Japan. They're sort of, you don't hear them wanting to put more of that on lately. You know what I mean? You haven't really heard like, we're going to take those interest rates really negative, or we're going to buy tons of more bonds. All that talk seems to have subsided a little bit in the face of the Fed just sort of saying, enough's enough. I think we're done. We're done with this and find another way. And I think that stocks are they seem happy about that. Like, okay, we don't need the Fed anymore. We can do it all on our own.
Well, what apparently isn't, or is done, I should say, really, is VVIX, the old volatility of VIX. While you were talking, I was just perusing a chart of our old friend VVIX. And, if you've been listening to the show recently, we've been talking about VVIX hanging in the high 80s into the 90 realm, even breaking through 100 a few times recently. Most recently, of course, but actually flirting close to it a few times back in late April and a couple of times again in mid-May, not that long ago. So this thing has flirted with the mid to high 90s very recently now, of course, in the wake of rally ho mode, in the wake of taking all the gas out ahead of the long weekend, ahead of everything else, where everyone kind of playing wait and see for the Fed decision in a couple of weeks. VVIX taking it on the chin, hovering right around 77 right now as we are recording the show. So VIX volatility taking a bit of a breather. Again, not exactly a surprising development. Again, we have a long weekend. We do have one big event kind of on the horizon, but it's not for a few weeks. So aside from that, I don't want to preface the crystal ball too much here, Mr. Rocklosser, but it is kind of hard to think of any other major drivers of vol for the next couple of weeks until Miss Yellen deigns to poke her head out again and decide thumbs up, thumbs down for the economy. Aside from that, not a lot else really on the earnings horizon or anything else really, kind of unless you're fixated on something right now, Mr. Rock Lobster. Aside from the ever dwindling VVIX, of course.
It is dwindling, and that's another thing too. Is that's how volatility gets into zone one, because VVIX has to drop into the low 70s or high 60s. So, and that's how it does it, because the bid for all that stuff goes away, because people aren't, they're not freaked out about it anymore. It doesn't mean that things can't happen, but when vol drops, that's probably one of the better bullish indicators around, where, if you got a lot of short deltas and you say, oh, this market is overbought, well, if they keep pounding that stuff, I tend to get out of the way when volatility in the VIX goes down, especially when it starts now getting down to the low areas. Now, obviously, it gets low enough where I want to try to find ways to buy it, because eventually, something will happen and people will freak out. But right now, it's kind of in that area where it could easily keep sliding down, and it slides down. And VVIX usually slides down because the market is taking a side out, meaning if usually volatility is really big when either move is potential. We have kind of those big volatile moves and we're up 30 handles or down 30 handles. That's really what makes volatility blow up. But when you're kind of just sort of going in one direction, meaning if we're just sort of this kind of bullish, slidey up thing, a lot of that big upside in VIX kind of goes away. There really isn't the bigger demand for it, because people just aren't seeing the downside in the market anymore. So if they take one side out of the market, at least the sentiment does, the vol goes down, and then that's what we've got. So if you see volatility in the 60s, which I think is certainly possible, that's, vol traders are just throwing up their hands and go, okay, we're going to let this stuff just drop and drop and drop, because nobody wants to buy it anymore, and we do not want to get in the way of this train. Simple answer.
The big train on the show is usually when I toss it to Russell for his Russell's Weekly Rundown. He, of course, is not here. I'm still going to play the music, though, Mr. Rock Lobster, because it just adds that certain charm, that certain joie de vivre to the program whenever we play it. Then maybe you and I will mine some VIX options data. So without further ado, let's dive into the not here Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
I don't know about
that
you.
Is awesome music.
That just cracks me up every time. I can't do the show without it. Even if he's not here, I'm still going to play it because it's just too fun. And we touched already on the VIX Cash. This is usually where Russell finds some needle in a haystack from a VIX weekly options perspective. Instead, we're going to look at, I think, the week that was from an overall VIX options perspective, because it was a bit of an interesting one. Like I mentioned, the VIX Cash started the week off pretty boisterous, pretty high level. Not so much from a VIX options perspective. Monday was actually the lightest day of the week from an overall volume perspective. In fact, we've already done more today going into a long weekend. 220,000 contracts haven't gone up so far today. Already done more today than all of Monday. Only 206,000 contracts gone up on Monday. So the week started off fairly light, and then spiked about Tuesday, 560,000 contracts, then about nearly 600,000 on Wednesday, then taken it on the chin again on Thursday, only about 260, a little over 250,000 contracts on Thursday. So not exactly the heaviest week, and today doing more than I think a lot of people expected, given the fact that people are pretty much standing in airport lines right now as we speak. ADV a little bit lighter than it has been of late, down to about 580,000 contracts out there in good old VIX options land. A couple of funky trades have been catching our eye out here of late, Mr. Rock Lobster. You are free to weigh in with any types of trades that have been catching your eye out there as well. We were talking before on the show about some interesting funky type three-ways. You can call them maybe combo/straddles versus calls. In this case, it was the June 19 calls versus the 17, call it what you will there. Could be a combo, could be a straddle. I'll have to dig a little bit more into exactly which side went up on that. But either way, going up nearly 40 40,000 times on Wednesday. So you're talking nearly 80,000 contracts on that 17 strike in June versus about 39,000 actually of those 19 calls. So a bit of a funky trade. Also saw a bit of a vertical there. The VIX 1924 vertical going up about 15,000 times, and that was on Wednesday, one of the heavier volume days of the week. Tuesday, also one of the heavier volume days, and we saw a bit of some love for the SEP 21s to the tune of looks like about 17,000 of those going up paper buy-in against the July 21, so a bit of a time spread again, similar size, about 16,000 contracts, nearly 17,000 going up there as well. And then Monday was a bit of an anemic day, not really much lighting it up size-wise that really caught our eye in any perspective, except for a little bit of a strangle. Looks like it was the July 18, AUG 24, so a bit of a time strangle, actually, going up about 5,000 times paper buy-in, both sides there. Other than that, there wasn't a lot of interesting or highly nuanced paper that we saw catching our eye. Certainly not something along the lines of our size 1x2 or 1x ratio trades, and then all the piggybackers that usually follow in mass like the lemmings off the cliff sometimes. Mr. Rock Lobster, any trades catching your eye out there? I know I did play the music for you, so you're free to play in the weeklies if you are so inclined, or perhaps in the VIX mothership if that caught your eye. Or I know you guys like to play every now and then in some of your favorite ETPs, like the predictably crappy VXX. So any options paper out there, any of those products really catching your eye this week?
What caught our eye was mostly put spreads like July and like downside put spreads in VIX, just people buying junk put spreads, which might not be too junky if the futures start to collapse a little more. So we saw more trades of sort of that ilk, with more bets on sort of long-term declines in vol. So that would be as far as seeing those types of trades go up. I thought that was interesting. We got a little unusual activity. Just somebody trading like 15 level, the 12 level calls in VXE. It looks like they're selling them on some sort of splits, which I find, what is that? Like a buy ride on VXE, but it's the same idea where it looks like with the vol collapsing, just there's steady sellers of upside premium or steady sellers of premium in VIX. And so far, there hasn't been a lot of response from it, meaning it's not going up. So I think that's the kind of the story, is people are just selling it. And the GDP news and any other good news is just going to be one more reason to keep selling it.
Speaking of selling and talking about VIX ETPs, XIV getting a lot of interest and love this week. I saw a lot of write-ups earlier this week that it had hit its high for the year, about 29.98. It is now indeed surging beyond that level, hovering right around about 31.30 as we are recording right now. XIV, of course, being your daily inverse short-term ETN out there. So a lot of people talking also about relative strength in that product and a lot of other indicators that we have poo-pooed many times on this network, but still, interestingly enough, I know VXX is one of your favorites, but I know you guys like to play in XIV as well, Mr. Rock Lobster. What's your take on this resurgence here we're seeing out there in XIV, setting multiple highs for the year this week? Seemed like every day was yet a new high this week.
It was. I mean, I'm full disclosure, I'm long this product. I like trading it when it's another product that does very well under certain conditions, and right now it's kind of in the thrivey condition because there's really, really juicy future premium, and XIV loves that. It hates a volatile market. It's funny, it's a volatility product, but it hates a volatile market. It loves a market like this where stocks are going nowhere and the future premium just gets savage. So on a day like today, when VIX cash is up 13 cents, right, and XIV is an inverse product, meaning as volatility increases, the value of XIV decreases. So then you go, well, VIX is up 12 cents. Why is XIV up 49 cents, 31.33 for the day? Because XIV shorts VIX futures. And the VIX futures today, again, are down on the day. Almost all across the term structure, they're all down. So when you look at it, you say, oh, wow. So XIV does very, very well. And in January, it was, I think, $16, and now it's $31. So the vol products, they, like I said, they act in very certain predictable ways when the market does certain things. And XIV is a product we like. That's something also I teach my students how to create straddles out of it, because options don't trade on it, so you have to use VXX or something else. You have to kind of cheat. But there are ways, so it gives you a little bit more flexibility to trade the volatility of the market. You can actually trade it by actually buying volatility straddles or selling volatility straddles, depending. But I have still a legacy position XIV. I got rid of 80% of the position 2 days ago because it had a pretty large run. So generally, with volatility, it reverts. So it generally only goes down so far for so long. And then, as we know, just like VIX, is making its trip down into 13. It seems to be very bouncy off this level this year. I think it's done it a couple times, so that was good enough for me. But I still have a little bit of it on, again, because conditions for it are favorable. The futures are expensive, and that decaying, rotting future is really good for XIV. It loves it. And you can see why on a day like today, the market really isn't doing much, but XIV is actually doing quite well. So, again, it's another thing. Go out, get some education, and see what happens. So it's funny. It's just as I say that, XIV starts to downtick a little bit. I guess Yellen must be speaking again because the VIX just jumped like 30 cents.
They hear you talking out there, Mr. Rock Lobster, and you're talking down your own position. Very brave of you. Talk down.
Well, against XIV, I own some VXX calls, so it's sort of it's okay. But at this point, the XIV is long run. It's run way past what the value of the calls are. So it's sort of think of it as a straddle, but the short side of the straddle, is really short. So that's why I took off a bunch of XIV. But it happens. You can talk down your own position, but it would at this point, since I can't lose money on it, I'm okay.
That's what we do here on the network. Not afraid to talk down our own positions. That's how honest and forthright we are here on the network. Moving back to what's been lighting it up in the mothership, the big VIX options for this week. The hot strikes du jour out there in VIX land. Number one with a bullet this week are the June 25s, 370,000. Those bad boys open out there, Mr. Rock Lobster. We kind of fall off a cliff then to number two, only about 295,000 of the July 30s, the ever optimistic July 30. Someone loving themselves some upside in July. Out to number three, the June 22 calls, a little bit more seasonable. 260,000 of those bad boys, followed by number four, 213 of the June 30s, the also optimistic June 30s. Got to go all the way down to number five, Mr. Rock Lobster, to find yourself a put on the hot list this week. It is the June 15 put with just a tick under 200,000 of those bad boys open as of this week. Biggest change, one of the biggest changes of the week, too, about 23,000 of those bad boys coming in this week. So propelling it up the list to number five. Number six, the June 20s, 185,000 open. Number seven, the AUG 30s, the increasingly optimistic AUG 30s, 178,000 of those. Then we find yourselves yet another put here on the list. You were talking about some put spreads going up, and I was talking about some put paper going up out there this week, and clearly puts climbing the list this week to the tune of the June 17s, 159,000 of those bad boys open, gaining about nearly 46,000 contracts in open interest this week. So clearly some love on the put side. Then June 26s, number 9, 154. And rounding out the top 10 of the hot strikes in VIX land with the June 24 calls, 146,000 total, about 6.3 million open, about 4.5 on the calls, about 1.8 or so on the puts. So a little light from an OI perspective. Again, not surprising given where we find ourselves on the trading calendar right now. We'll see if that'll change in a couple of weeks as the Fed keeps peeking out from their hole in the ground and saying, don't forget about us. We're still coming sometime down the line. Before we move on completely from broad market volatility, Mr. Rock Lobster, we are kind of in the tail end of earnings season. Not a heck of a lot really left on the radar in terms of large market movers, large sources of volatility. That said, was there any real interesting earnings vol talk in the old pit chat this week? Anything catching your eye?
Let's see. We had some latent positions in Walmart and Cisco from last week. We are looking at a position. We're looking at some Ambarella, which is a semiconductor stock that has huge potential movement, and the June straddle is only $4.25. So, yeah, we haven't. Weird again. The market has been, funny enough, underpricing a lot of straddles actually. So we have been looking at them. We're going to see if this AMB might be something to trade for next week. AMBA, I guess. But mostly we just watching how stocks have been priced on these things. So what's weird is sort of the big sort of momentum-y tech stocks seem the straddles always have been trading kind of cheap, and sort of the let's just call them the non-momentum stocks actually have been those earnings straddles have been actually way outperforming how they've been pricing them. So kind of a strange this little strangeness, I guess, is the simple way to put it. But for the most part, a lot of earnings straddles have been cheap from just straight up observation of this cycle anyway. So, of course, I found that interesting.
Yeah, it has been kind of a couple of different narratives you could look at here from an earnings vol perspective. It seemed like earlier in the cycle, there was definitely the narrative, I think your better half there, your cohort, your partner in crime over there in the land of the pit, the greasy meatball, saying it was the great earnings sandbag. Everyone was sandbagging their earnings and then blowing through their straddles. Then we saw a bit of a flipping of that script as all of a sudden a lot of things were overpriced and people not exactly hitting it out of the park anymore. Then we kind of saw it flipping the fulcrum, swinging back the other way. So it's kind of been an interesting season to watch on that perspective. You know what has been interesting, though, Mr. Rock Lobster, talking about volatility. This is the portion of the show where usually we shift into crude or maybe gold, some other commodity vol. I'm going to bring up commodity. I don't think we've discussed on this program before, but it certainly has been taking up a lot of airtime on some of our other programs on the network, including long and short of futures options, and of course the ever popular brand new edition this week in futures options. Yes, I'm talking soybeans. We're going to talk soybean volatility here on Volatility Views. Mr. Rock Lobster, did I just blow your mind?
You know what? You blew my mind just a little bit. It's like you threw a bean at me. A big bean.
And then I doused you with some meal. Let's get into the soybeans, because it has been just kind of, I think crazy town is a technical term out there in soybeans of late. You know, there's a lot of phenomenon that go on out there in the commodity and the futures options that people traditionally on the equity index side aren't used to. The limit up, the limit down, what happens there, the underlying is just down, the options still trade, which is kind of crazy town. You have to price off the synthetics. I'm blowing people's mind left and right here, but it is kind of a weird thing. We have seen a lot of that out there in soybeans of late, very recently. In fact, just on the 10th, I believe it was, when the USDA data came out, soybeans hitting their limit up. They're saying soybean stocks are lower than expected. So, of course, that's going to drive up the price. We've seen a lot of back and forth, hither and yon, weather out of Brazil, issues coming out of Argentina, who's the major producer. Also, some other issues going along out there, Chinese demand, what's going on out there. All these things kind of combining for a very interesting scenario out there in soybeans. Actually, it's been kind of interesting, Mr. Rock Lobster. You know, a lot of our listeners are used to the index vol, the equity vol. They're used to that traditional volatility skew, where, of course, the downside puts have the premium, the calls not so much. The underlying rallies like we're seeing today out there in the broad index land, vol's supposed to come off, right? That's how it works. Well, not so much in the commodity realm where skew is a little bit more of a fickle beast. It kind of depends on the product. There's no such thing as kind of investment skew across the board. And what we've seen out there in soybeans land of late actually has been interesting. Has been a bit of a rally, and also a rally in vol as well. We've seen a heavy premium to the call wing out there from a skew perspective, and decent, relatively attractive levels from a put premium perspective. That's changed a little bit this week. We've seen some paper flocking into the puts out there in soybeans this week. But for a while there, particularly early this month and going in, still very much now, you could go out there if you were a producer or a farmer or just someone who's long beans and wants some protection. You could buy pretty aggressive protection, $1 or so out of the money puts, and then turn around and sell $2-3 out of the money calls because the calls were so elevated, and get that for even money, perhaps even a credit, depending on how you worked it. So it was a pretty attractive perspective from a skew, certainly from a skew viewpoint. We're still seeing a lot of that data right now. So collars, bearish risk reversals, it was great setups out there. I think we're actually talking on the long and short of futures options program earlier this week about looking back on the year's worth of data from a skew perspective out there in soybean land. It was about still the 95th percentile in terms of attractiveness for where it's been over the past year in terms of setups for buying those puts, selling those calls. It has been very attractive. Again, puts leading the charge this week. So when we break down all that data later today on This Week in Futures Options, we'll see how much all that put love has changed the scenario, if any. Maybe it hasn't changed it too much, but still. I'm trying to remember I don't think we've ever discussed beans here before. Mr. Rock Lobster, do you have any wherewithal with beans at all? I mean, there's not many ETFs floating around that really do a good job of tracking the beans. So you're not really a beans guy, are you?
I'm not. Well, a couple of years ago, I think there was an ETF. What is it, SOYG or is it SOYB? Yes, I remember the soybean, the Tucrium.
Yeah, I'm looking at it right now. Tucrium. Soybean fund. That's a name. That's a mouthful of soybeans.
Yeah. I remember now. This is a friend of a couple of our pro guys been trading the volatility in the soybeans, all the grains. They said they were blowing up. Early February, the product was $17 and it's $20, which is a pretty monumental. It's a giant move for soybeans. The last time we looked at vol was when we had that crazy drought a couple years ago. In corn, and corn was all over the place. Yeah, corn
was all over the place, yeah.
So this product actually has some of because I think that does a better job of buying futures. I think they buy the midterm futures, and they try to alleviate some of the contango backwardation problems and stuff like that. But it's an ETF, though, that does trade soybeans, and it does a pretty good job of sort of tracking what soybeans do. Again, but it's any fund that buys futures. It has those kind of, let's just call them issues, I guess. It's not trading. I mean, it's not trading a lot of options today. I think mostly because people don't know about it. But, and I believe there was one for corn as well. And I think it just might be called corn, as I recall. It's been a while since I've looked at it. Yep. It's the Tucrium Corn Fund. So, is kind of a trade by appointment. The markets aren't too bad in there, and I think the reason why is you could trade the corn options in the actual futures. That way they can make fairly decent markets. Somebody's going to arb the two markets. So as far as volatility goes, I just know that there has been, for whatever reason, there's been a lot more shaking up in the commodities. Members gold kind of rose this year, so it is an interesting way to take a look at them. But they're not super active products. That's what I would say. They could be a little Roach Motelli unless they really get hopping.
I'm looking at this Tucrium soybean fund, Soyb. if you are so inclined, listeners, and you're right, trade by appointment. In terms of no one made an appointment today to trade, so no volume going up today. Open interest is actually off out there, which is kind of surprising, given how much it's moved. Like you said, it's up a couple of handles just in the last couple of months, and this thing's been averaging about 1,100 contracts open interest, only about half that out there right now. So maybe someone took a big position off. Again, just so few trades out there. One guy is going to dictate how this looks, but still kind of interesting that open interest actually weaker out there than we have seen of late. So who knows? Perhaps that may intrigue you to check out the soybean, the Sucrium soybean fund. I like the name. Very catchy. Just rolls off the tongue. Sucrium. You mentioned gold. Let's hit gold really quickly because you got to talk a little bit of gold, right? When you're talking all things volatility. I'm not sure if you had a chance to chat about it of late, Mr. Rock Lobster, but you love GLD, and apparently so does your best friend, Mr. Soros, out there, loading up on about 260 million, about $250 million of the Barrick Gold miner ABX, and then on top of that, picking up about 1.1 million. They don't say which strike. I'm guessing he spread that out a little bit of GLD calls. So loving himself some gold, and that wasn't enough. He also picking up about 2.1 million SPY puts. Again, no strike breakdown there. You got to imagine the latter probably a hedge, particularly because he's using SPY, not SPX. Kind of interesting there. But in terms of the gold love, that's kind of maybe we're going to see a return to the crazy upside love of gold like we saw back a few months ago, back in Feb, when you couldn't get enough of the 1x2s. Everyone and the mother was talking 1x2s in gold, GLD, the big futures, the futures options. I don't care where you were looking. Everyone loved themselves some gold 1x2s. Who knows? Maybe Soros is the canary in the coal mine, Mr. Rock Lobster. What say you to that?
I don't know. He's got more money than me, so he's probably he's usually right.
Isn't he also the guy who infamously bought all tech in like February of 2000, something along those lines? Probably one of the worst time trades in the history of mankind. He held out on tech, didn't want to touch it, and then bam, it was him or Buffett, I forget which one it was, who piled into tech en masse right before it all imploded.
It wasn't Buffett.
Yeah, it was Soros.
I thought it was Julian Roberts. It was like the Tiger Fund guy, or I don't know if it was Soros. But I thought it was like, I don't remember which guy. They just, when the valuations of the market got so high, and like, I can't buy it, and all his investors are screaming, we're not in. So we got them all in, and it was at the top, and everybody was sad, and there were tears. The gold thing is, it's had such a huge rally. It's just, when did he buy all of his gold stuff? But it's all of a sudden gold's looking a lot worse because interest rates might be going back up, and everybody's been playing this inflation thing for a long time, and it kind of rears its head and then it goes away, and it rears its head and it goes away. Maybe he's right, but at the same time, he might be long. He might be buying a lot of puts, but he also might be buying a lot of S&P 500 as well. Just creating a massive synthetic strangle, which seems to be what the guy likes doing, and he lets it ride. That's probably why he's rich. He can probably ride a position longer than anybody else. So if he's buying a lot of puts, my guess is he probably has some sort of long against it, and he's just waiting for the market to do one thing or the other. So he likes buying his juice cheap too, apparently, because with VIX at 13, it's a whole lot cheaper than when it was trading 28. So we'll see. I'm assuming he's probably long some equities or has some equity exposure somewhere, but
yeah, it's important
maybe
to note.
not.
Important to note when he put this out. These are from filings from Q1. These are about a 45-day lag time, obviously. So he could have rolled out all of this. Not likely, but he could have rolled out at least some of this by now. But it's still interesting nonetheless. Speaking of which, just looking as you were talking, Mr. Rock Lobster, it was Soros because his quantum fund took a bit of a hit back in I'm looking at a write-up here from back in March of 2000 saying Soros' traders watched in horror when the tech-heavy NASDAQ Composite Index plunged 124 points on March 15th, while the once quiescent Dow Jones leapt 320 points in just 5 subsequent days. The Soros firm's flagship quantum fund saw what had been a 2% year-to-date gain turned into an 11% loss, and I think it kind of spiraled down from there. So it was Soros who had one of the. So maybe this is perhaps this is our contrarian indicator. Forget the canary in the coal mine.
Done it.
Yeah, the canary's already dead. Get the hell out of there. That's what this is saying. Either way, yeah. Hopefully if this bet is as well timed as his tech bet, then perhaps we should all pay attention and get the heck out of Dodge. Meanwhile, it's almost time for us to get the heck out of Dodge. We got one last segment. This is the portion, of course, where we embarrass ourselves immensely. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. Like the man says, this is the portion of the show where we gaze into the murky future, attempt to divine what the vol gods hold in store for us for the coming weeks. It was, like we said at the top of the show, a bit of an interesting week, bit of an interesting to watch the VIX cash kind of amble its way on down, but then hit that floor where it was kind of this far, no farther. So that's kind of been interesting. Mr. Rock Lobster, you haven't been on in a while, so I'll give you choice. Do you want to go first or last here on the old crystal ball?
I will go first.
All right, go for it, sir.
So I'm going to say by Friday on the close, because it'll be after a non-farm payroll number and everything else, we will be at 1295. We are breaking into zone 1. That is my prediction.
I was going to say that's zone 1. Zone 1, Russell. Is there like a klaxon that goes off in Option Pit headquarters and that goes off like the DEF CON thing, red alert, zone 1, something like that?
It's like the little minions, and they go, wee-ah-wee.
That's exactly.
That's what happens.
Does he come breaking through the wall with his axes going, wee-oo?
Exactly.
I picture that in my head now. That'd be kind of a fun thing to see at the Option Pit HQ. Zone 1, wee-oo. I like that. Yeah, so you're kind of leaning the way I was leaning. I don't know if I'm not sure if I'm as bearish as on vol. You're right though. I don't think post non-farms we got that'll be the big driver. Obviously, that's why it's so fun guessing on a non-farm day, because what happens what VIX cash is in the morning and what VIX cash is at showtime. Two very different things, and
exactly.
Could be 3, 4, could be 3, 4, 5 handles different by the time we start recording. There have been many days when we were right in the morning and then wrong in the afternoon, and vice versa. So that's the big question mark out there. But I was leaning somewhere lower, but you already went lower, so I'm going to say right about where we are right now, but I'm going to say about 13.5. That's what I'm going to say. Because I'm not feeling the love. I'm not feeling any upside. I'm certainly not feeling any Russell buying all the vol in terms of
he's choking on that vol.
That guy he's been every 17, 18. I think he was 25 once. So he was buying what they were selling and not exactly liking it all the way down here to 13. Yeah, he's not exactly. Maybe I'll see if I can track him down before the end of the show. Maybe I'll see if I can squeeze out of him a volatility crystal ball prediction. He is lurking somewhere in the SIBO. He has been found. I think he got hit on the head and he's a little lost and dazed and confused. But that said, we are going to have to wrap it up here for this episode of Volatility Views. That music means it's time to bring this episode to a close. But before we go, one last time, Mr. Rock Lobster, you're talking about Zone 1, Zone 2, Zone 3, all that goodness. Where can folks go if they are so inclined to learn more about the zones and whatever else you guys are cooking over there in the land of the pit?
Yep, you can go to the Option Pit store on our website, surf on over to optionpit.com. Go to the store and look at all our volatility primers. We have vol classes, vol primers, all kinds of stuff. I believe we have a VIX and volatility products one, which goes into kind of detail on setting all that stuff up. Also, just be an Option Pit member. Gold, our best deal is gold because it kind of gives you all access to just about everything. And we also have June 11th. We're going to have our Condor and Butterfly class. And we might slip the zone stuff into that class. Little Birdie is saying that they might.
Zone 1, Zone 2. Get all your zones in, listeners.
Get in your zones.
Learn your zones over there in the land of the pit. And Russell couldn't join us, but of course, check out what the gang is cooking over there at CBOE Live Vol. They, of course, bring us a lot of the data that we talk about on the show here. So all the funky data and the implied vol and the VIX numbers and everything else we're talking about throughout the show. Most of that comes from our friends over there in the land of live vol. By the way, I had an interesting sit down with Kathy Clay, the president over there of CBOE Live Vol. So check it out on our network coming out of the OIC conference if you haven't done so. It talks a lot about the data shop and the cool stuff that they're offering over there. So if you're interested in data, but you just want a little chunk, you don't want to take down the whole fire hose of Opera data, well, they can carve that out for you and price it accordingly. So check it out. That's datashop.cboe.com. And on behalf of the Rock Lobster and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. Didn't get a chance to get to them this week. I apologize, but we'll get to those on the next episode, and we'll see you next time for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.